First, the tailwinds. Silver has long been discounted, treated as a fringe player compared to gold, but the constellation of forces has changed. Industrial demand, from photovoltaics, from electronics, from emerging green technologies, is accelerating. Monetary and fiscal frameworks are evolving, and inflationary pressures, supply chain tightness, combined with policy uncertainty, are creating an environment in which silver cannot remain static. The world has changed more in the last decade than in the previous 50. We've witnessed innovation racing ahead of policy, markets evolving faster than traditional systems can adapt, and digital networks connecting capital in ways once unimaginable. Yet, amid this transformation, one truth is becoming increasingly clear. Depending on a single currency, a single system, or a single belief in what defines value is no longer sustainable. When we think about the way our financial system operates, it's built on layers of trust. Trust in governments, in central banks, in the idea that a piece of paper or a number on a screen represents value. That model worked when global growth was linear, when productivity was predictable, and when money moved slower. But today the world doesn't move linearly anymore. Technology has changed the speed, scale, and transparency of capital, and with that change comes the erosion of blind trust in one currency to anchor the entire world. Over the past few years, we've seen repeated reminders that the concentration of power in one currency carries risk. When monetary policy tightens in one economy, liquidity drains across the globe. When inflation rises in one region, nations thousands of miles away feel the shock. This interconnected fragility is not a sign of strength, it's a symptom of dependence, and dependence is dangerous in times of transformation. Innovation is decentralizing everything. It's decentralizing communication, production, energy, and now money itself. Digital assets, blockchain technologies, and algorithmic systems are rewriting the architecture of finance. They're doing what the internet did to information, making it open, borderless, and adaptive. And yet, many investors still think in the language of a single currency. They measure everything, growth, profit, even progress, in one denomination. That's not forward thinking, that's legacy thinking. When you depend on one currency, you depend on the policies, politics, and perceptions that govern it. You surrender control of your purchasing power to decisions made in rooms you'll never enter. And if history has taught us anything, it's that monetary regimes change, sometimes suddenly, sometimes quietly, but always inevitably. The British pound once reigned supreme. Before that, the Dutch guilder. Every era has its symbol of dominance. But no symbol lasts forever. We are at the early stages of another rotation, a rotation not just in assets but in ideology. The world is beginning to question what money truly is. Is it a store of value, a medium of exchange, or a technological protocol? Is it something printed, or something mined, coded, or created through innovation? The answers to these questions will shape the next generation of wealth. For investors, this is not a time for fear, but for understanding. Diversification is not just about owning different assets, it's about owning different systems of value. Real assets like commodities, innovative assets like blockchain-based networks, and productive assets like technology companies all represent alternative expressions of value. The future of wealth won't be defined by holding more dollars or euros. It will be defined by holding more exposure to the forces that define the next economy. We're moving toward a world where currency is no longer static. It's programmable, it's adaptive, and it's global. Those who understand this shift early will be positioned for the next wave of growth. Those who ignore it may wake up one day to find that their purchasing power has quietly eroded, not through a crash, but through gradual obsolescence. Think about what's happening. Governments are testing digital currencies. Corporations are holding digital assets on their balance sheets. Individuals are transacting peer-to-peer without intermediaries. These aren't fringe movements. They're the new building blocks of a parallel financial system that's rising in plain sight. The world is diversifying, not just economically but monetarily. The question is whether we as investors are keeping up. Are we still measuring the future through the lens of the past, Or are we ready to embrace a world where value can exist beyond the borders of one system? The next decade will reward those who understand asymmetry, those who recognize that true stability comes from optionality. In a world of uncertainty, reliance is risk, and flexibility is freedom. So, as you think about the future, ask yourself, are you anchored to one system, one story, one currency? Or are you positioning yourself to benefit from the evolution of money itself? Because the greatest opportunities often emerge not when the world feels certain, but when it begins to question the very foundations of what it's built on. The era of depending on one currency is ending, quietly but unmistakably. The next era belongs to those who see beyond it. In times of rapid change, clarity often comes from simplicity, and simplicity begins with something timeless, owning what's real, not paper promises, not synthetic derivatives, not algorithms of speculation, but tangible, essential, productive assets that stand regardless of inflation, policy shifts, or digital illusions. In a world that is increasingly abstract, the power of owning real things has never been more profound. When you strip markets down to their essence, everything begins and ends with real value, real assets, land, metals, energy, innovation, intellectual property. These are the foundations that civilizations have been built upon. And yet, somewhere along the way, we began to trade symbols of value rather than value itself. We built layers of abstraction. Futures, options, synthetic exposures, derivatives of derivatives, all designed to replicate ownership without actually holding the thing of worth. But here's what happens when the system starts to strain. The illusion fades, the promise of liquidity meets the reality of scarcity, the faith in policy meets the truth of supply and demand, and in those moments, real things, the things you can touch, use, or create with, suddenly reveal their strength. Look around the world right now. Inflation may have cooled in data, but not in behavior. Currencies fluctuate. Markets swing between euphoria and fear. Governments intervene, trying to stabilize what they can. But the world doesn't stabilize through decree, it stabilizes through productivity. Real things, energy, technology, resources, are what anchor economies to reality. Owning real things doesn't mean rejecting innovation. In fact, innovation itself is a form of tangible value creation. The servers that power artificial intelligence, the factories that build electric vehicles, the solar panels that harness sunlight. These are not speculative ideas. They are real. They represent a transformation of physical reality through technology. Owning pieces of that transformation, whether in commodities, companies, or intellectual property, is what owning real things means in this new era. For too long, investors have been conditioned to chase numbers on screens, yields, returns, percentages, but numbers can be manipulated, fundamentals cannot. Real assets do not vanish when algorithms change or when liquidity dries up. They may fluctuate in price, but their underlying utility endures. That's what gives them resilience. That's what makes them the quiet core of every lasting portfolio. The most powerful movements in history have come from periods of revaluation, when people realized that the abstract had drifted too far from the concrete. The 1970s taught that lesson. The dot-com collapse echoed it. And today, as we navigate an economy stretched between digital exuberance and physical scarcity, that lesson is resurfacing again. You cannot digitize scarcity, you cannot print productivity, and you cannot replace ownership with exposure forever. Real ownership builds confidence. It gives you a base, something that does not depend on another's promise. Whether that's owning a productive piece of land, a company that manufactures the future, or a metal that powers the next energy cycle, it represents freedom from fragility. It's not about nostalgia or going back to an old system, it's about grounding the future in reality. We are entering a decade where tangible value will reassert itself. Energy systems are shifting, supply chains are localizing, resources that were once taken for granted, lithium, copper, silver, water, are now recognized as strategic. Real assets are not just stores of value, they're stores of future potential. They're what innovation builds upon. And while digital assets, artificial intelligence, and automation will continue to reshape industries, even they require something real to stand on. hardware, data centers, energy inputs, physical infrastructure. Innovation cannot exist in a vacuum. It must be grounded in materiality. The key is balance, understanding that the future belongs not to extremes, but to integration. The digital and the physical will coexist, but in that coexistence, owning real things provides the anchor. It's what allows investors to weather volatility and stay focused on long-term structural growth rather than short-term noise. So as you think about where to position yourself, remember the next great wealth transfer won't just favor those who chase trends, it will favor those who own foundations. Real things endure through cycles, through policy shifts, through innovation waves. They are the bridge between uncertainty and opportunity. Because in the end, everything that creates real value, every technology, every company, every advancement, is built on something tangible. The world can digitize everything but truth, and the truth is simple: owning what's real is not just about protection, it's about participation in the future that's being built, one tangible piece at a time. Every investor faces the same paradox: the desire for growth and the need for safety. The art of balancing both defines whether portfolios merely survive or truly evolve. And in moments of volatility, when confidence shakes and markets swing between optimism and fear, one principle quietly separates resilience from fragility: diversification. Not as a cliché, not as a checkbox on a strategy sheet, but as a dynamic philosophy, a way of thinking about protection through adaptability. The world today moves faster than traditional models can comprehend. Innovation cycles are compressing, monetary regimes are shifting, and geopolitical structures are reordering. Concentration might look brilliant in a bull market, but it becomes exposure in a downturn. Protection no longer comes from predictability, it comes from preparation. And diversification, when understood correctly, is not dilution, it's optionality. It's the power to participate in the future while surviving the unknown. In every transformative era, investors are tempted by narratives of certainty. One asset class, one technology, one region, one currency, each becomes the next big thing. But history humbles that kind of conviction. Every dominant story eventually meets its counterforce. The same innovation that drives exponential returns in one decade can disrupt those very gains in the next. True protection means acknowledging that no single idea, no matter how powerful, can capture the entire landscape of opportunity. Diversification at its core is about exposure to change. It's about owning the present while being ready for what comes next. The future of investing isn't about betting everything on one outcome. It's about building portfolios that thrive across multiple possible futures. That's what the most forward-thinking investors understand. They don't try to predict, they position. They don't rely on static models, they evolve with the data. The most misunderstood aspect of diversification is that it's not about owning more, it's about owning meaningfully. It's not a scattershot approach, it's an intentional allocation of conviction across different vectors of growth. Technology, commodities, innovation, real assets, digital systems, each behaves differently in response to the same global forces. Inflation, deflation, policy, productivity, none of these impact every asset equally. The goal isn't to eliminate risk, but to diversify the kind of risk you take. In the past, protection meant holding cash or bonds. But today, in a world of shifting interest rates and changing policy frameworks, protection looks different. It might mean exposure to innovation, where deflationary forces of technology can counterbalance inflationary ones in commodities. It might mean owning real assets, tangible stores of value that don't vanish when liquidity dries up. It might mean embracing digital networks that transcend geography. The definition of diversification has expanded, just as the definition of risk has evolved. What we're seeing globally is the breakdown of the old correlation map. Assets that once moved together are now decoupling. Traditional hedges are failing to protect. And that's where adaptive diversification becomes essential. The willingness to rethink what safety looks like. The investor who refuses to evolve with the system eventually becomes a prisoner of it. Diversification is not just financial, it's philosophical. It reflects humility, the understanding that no one can foresee every shift, every policy change, every technological leap. It's the recognition that resilience is built not from control but from flexibility. When you diversify across time horizons, asset types, and innovation cycles, you give yourself the freedom to stay invested through volatility, through doubt, through the noise that distracts so many from long-term vision. The most successful investors in history didn't just find the right assets, they built the right frameworks. They didn't avoid risk. They managed it through structure. And that's what diversification truly is: structure. A living, breathing system of balance that allows your conviction to survive uncertainty. The coming decade will reward this mindset more than any in recent memory. We are entering an era of creative destruction, industries rising and falling faster than models can adjust. AI, robotics, clean energy, biotechnology, decentralized finance. Each of these represents massive opportunities but also distinct risks. Diversification allows you to participate in the exponential while withstanding the cyclical. It's what lets investors stay long-term in a world obsessed with the short term. So as we look forward, remember, protection is not about retreating from risk, but about expanding the framework of opportunity. A well-diversified portfolio doesn't fear disruption, it feeds on it. It's positioned not for certainty but for evolution. Because ultimately, diversification is not just protection from loss, it's protection for growth. It gives investors the freedom to believe in the future without being captive to any single version of it. It's how you stay strong when everything changes. It's how you remain confident when others panic. And it's how you turn volatility, the language of innovation, into long-term advantage. Every generation believes its moment is different, that the rules have changed, that history won't repeat. But cycles always remind us otherwise. They may not look the same, they may not move on identical timelines, yet beneath every boom and bust, every surge and correction, lies the rhythm of human behavior. The markets don't move in straight lines, they breathe. Expansion, contraction, recovery, renewal. It's a pattern as old as progress itself. To think long-term is to see through the noise and recognize that cycles are not interruptions to growth. They are the structure of it. Today's world is moving faster than any era before it. Innovation compounds, capital flows at digital speed, and information spreads globally in seconds. But even in this accelerated environment, cycles persist. They just evolve in form. We are living in the intersection of technological acceleration and financial recalibration. The temptation to react to every market swing has never been stronger, yet the greatest investors understand that reacting is not strategy. Endurance is. And endurance requires perspective. When you think in cycles, you understand that downturns are not endings, they're beginnings in disguise. They cleanse excess, reset valuations, and prepare the ground for the next wave of innovation. Every disruptive technology that reshaped the world, from electricity to the internet to artificial intelligence, was born in a moment of skepticism, not euphoria. The long-term thinker doesn't look for comfort in the crowd, they look for conviction in data, direction, and change. In the short term, markets are emotional. In the long term, they are mathematical. Fear and greed dictate months, fundamentals dictate decades. The market's constant fluctuations are not signals of failure, they are reflections of adjustment. Each phase of a cycle reveals who understands the game and who is merely reacting to it. The ones who win consistently are not those who predict every move, but those who position themselves for the compounding effects of structural trends. Right now, we are witnessing multiple cycles overlapping: monetary, technological, and generational. Central banks are adjusting from decades of easy liquidity to an era of recalibration. Innovation is shifting from speculative hype to real-world application. A younger generation of investors is redefining what value means, prioritizing long-term sustainability over short-term performance. This convergence creates friction, volatility, uncertainty, but it also creates opportunity, the kind that only comes once every few decades. Thinking long-term means accepting discomfort. It means holding conviction when narratives turn against you, when prices move the other way, and when the noise grows deafening. It means understanding that exponential progress rarely looks smooth in real time. In fact, it often looks like chaos until hindsight turns it into clarity. The innovators, the visionaries, the patient investors, they endure the in-between because they see the arc before others do. If we study history, every major wealth creation moment came from recognizing long-term shifts in advance. The Industrial Revolution, the Digital Revolution, and now, the technological convergence of energy, AI, genomics, and automation, these aren't isolated stories. They're connected through the same pattern. Creative destruction followed by exponential renewal. The market doesn't reward those who chase momentum, it rewards those who anticipate direction. Cycles also remind us that time is the ultimate equalizer. The compounding of good decisions held over years outperforms the illusion of fast wins. That's not just a financial truth, it's a philosophical one. Patience in a world addicted to immediacy is now a competitive edge. The investor who can zoom out, who can withstand correction and stay aligned with long-term conviction, will outperform those who seek validation in short-term results. Long-term thinking isn't passive, it's deeply active. It means continuously reassessing data, challenging assumptions, and staying aligned with innovation as it unfolds. It means recognizing that cycles don't end, they evolve. Each new phase begins before the old one is fully recognized. The challenge is to see it before the consensus does, to look through the downturn and see the seeds of the next upturn forming quietly underneath. So as you navigate this period of uncertainty, remember that every cycle brings both pain and potential. Short-term turbulence often conceals long-term transformation. The key is not to time the cycle, but to align with it, to invest in themes that transcend volatility, in technologies that redefine productivity, in assets that will still matter when the current headlines fade. Because in the end, thinking long-term is not just a strategy, it's a mindset. It's the discipline to resist the noise, the courage to stay invested in the future, and the vision to recognize that cycles don't destroy value, they redistribute it. Those who see farthest act earliest. Those who act earliest benefit most, and those who think long-term ultimately are the ones who shape what comes next.